let's jump right in. With individual taxes, there were significant changes going into from 2017 into 2018. And what I've got here is a chart that shows you these changes, starting with the standard deduction that's allowed for individual taxes. All right. So right off the bat, you can see a big jump occurred from 2017 into 2018 for these numbers. Basically, pretty much these numbers doubled. All right. So that's one of the major changes that we had with the tax reform bill. And you can see that there's a slight increase from 2018 to 2019 with these numbers. But the big jump occurred from 17 to 18. So that's one major change that we're seeing this year. Big jump in the standard deduction. And if you know what that means in terms of the deductions or how you pay taxes, that means that probably fewer people are going to be itemizing. Because if your itemized deductions are less than the standard deduction, then of course you would take the standard deduction. Why not? Why not take the higher amount? So with this doubling, basically doubling of the standard deduction, that means there's going to be many fewer folks, taxpayers, that are going to be taking the itemized deductions. They'll be taking standard. Also, a big change we have for this year is the personal exemption. That exemption that you get for you and your spouse and your kids, that's gone. And that basically is suspended through the year 2025, at least for individuals. I've got a note on there about estates and trusts. They still have their exemptions. But as far as individuals are concerned, basically those exemptions are gone. And that's a big deal, especially if you have a big family or something that you've been able to take advantage of in the past. So as we'll see in a little while, I'll talk in a few minutes about a new credit that's available, or an increased credit for children and dependents. So that should make up for it somewhat, but still it is a big blow to not have those exemptions anymore. All right, here are the rate brackets, the ordinary income rate brackets for 2019. If you can't see that in the back, I apologize, but I wanted to put this in here with a lot of detail so that when we send out the slides, you'll be able to have that available to you. But one of the big changes as well with 2017 tax reform is that specifically for married, joint, and mainly for the married column here, you see a big broadening of these upper income rate brackets, which means that a lot more income is taxed at slightly lower rates. So that's good. But as you can see, I've highlighted here the single and head of household columns. Those brackets actually shrunk a little bit compared to 2017. So that's an interesting dynamic there, and part of the reason for that was to alleviate the so-called marriage penalty. So in the past, you might have had a situation where two individuals who were not married could file returns as single individuals and actually pay less tax than if they were married. Well, this alleviates that. So unfortunately, instead of it's a situation where you actually could be now paying more tax if you're single or head of household, if you're in these middle brackets right here. So just to point that out. But overall, for those who are filing married, you do have a much broader brackets where you're paying less tax at the higher income brackets especially. All right, some more changes, big changes here. Moving expenses, basically these are suspended. So through the year 2025. And you'll see that with 2017 tax reform, a lot of these changes are only good or only in effect from 2018 through 2025. There is a sunset in this legislation. So moving expenses in the past, if you moved more than 50 miles, it was moving for a job change or some other reason like that, you could deduct your moving expenses, no longer available, unless you're in the military and you have orders to move, and then you're eligible for that deduction. Also, some big changes with alimony. And this is something that we actually are just now in 2019 seeing the actual implementation of this change. So before 2018, if you had an alimony agreement with an ex-spouse, generally the spouse who was paying the alimony could deduct that, and the one who was receiving the alimony was taxable on that alimony. Now, any existing agreements that are in place are grandfathered, so it won't affect anything in the past. But any new agreements starting in 2019, so after December 31st, 2018, there's no more deduction and no more taxability. So I think that's a big change, but most likely what we'll see happen is you'll just kind of shift the amounts and kind of recalculate the amounts of the alimony, taking into account that there's no deduction and no taxability for it. Shouldn't be a major change, but it will make life a lot simpler because you won't have to report that anymore. But we'll see what happens as we're just in the beginning of 2019, and we'll see how divorce agreements evolve based on this.